Welcome back to Smart Trading Institute. If you're new here, don't forget to hit that subscribe button and click the bell icon to stay updated with our latest videos. Today, we're diving into the basics of futures contracts. Whether you're a beginner or looking to refresh your knowledge, this video is for you. Basics of futures contracts. First things first, what exactly are futures contracts? Simply put, a futures contract is a legal agreement to buy or sell a particular commodity or financial instrument at a predetermined price at a specified time in the future. These contracts are standardized and traded on futures exchanges. Futures contracts are used by two main types of market participants, hedgers and speculators. Hedgers use futures to protect against price changes in the underlying asset, while speculators aim to profit from price movements. Now let's break down the key components of a futures contract. Underlying asset. This is the commodity or financial instrument that the contract is based on. Examples include agricultural products like wheat and corn, energy products like oil and natural gas, and financial instruments like stock indices and currencies. Contract size. The amount of the underlying asset covered by the contract. For example, one crude oil futures contract typically represents 1,000 barrels of oil. Expiration date, the date on which the contract expires and the transaction must be settled. Futures contracts have specific expiration dates such as monthly or quarterly. Price, the agreed upon price at which the asset will be bought or sold. This price is determined by supply and demand in the futures market. Margin requirements, the minimum amount of money that must be maintained in your account to hold a futures position. This acts as a security deposit to ensure both parties fulfill their obligations. Understanding these components is crucial for anyone looking to trade futures. Each element plays a vital role in how the contract functions and how traders can use them to their advantage. Let's see how futures contracts work in practice. Imagine you're a farmer who wants to lock in a price for your corn crop to protect against price fluctuations. You can enter into a futures contract to sell your corn at a set price when it's harvested. On the other side, a food processing company might enter into a futures contract to buy corn at that same price to ensure they have a steady supply. In this scenario, both parties benefit. The farmer secures a guaranteed price for their crop, reducing the risk of price drops, while the food processing company ensures they have a reliable supply of corn at a predictable cost. There are various types of futures contracts available in the market, each catering to different needs and interests. Some common types include commodity futures. These involve physical commodities like gold, silver, oil, and agricultural products. Financial futures. These include contracts based on financial instruments such as stock indices, interest rates, and currencies. Single stock futures. These are contracts to buy or sell a specific amount of a particular stock at a future date. Index futures. These are based on stock market indices like the S&P 500 or the NASDAQ. Each type of futures contract has its own characteristics and uses, making them versatile tools for different trading strategies. Trading futures can offer several benefits such as hedging, protecting against adverse price movements in the underlying asset. Leverage, controlling a large position with a relatively small amount of capital. Liquidity. Futures markets are highly liquid, allowing for easy entry and exit of positions. Diversification. Access to a wide range of markets and assets. However, it's important to be aware of the risks, including market volatility. Prices can fluctuate significantly, leading to potential losses. Leverage risks. While leverage can amplify gains, it can also magnify losses. Margin calls. If the market moves against your position, you may be required to deposit additional funds to maintain your position. Complexity futures trading requires a good understanding of the markets and the specific contracts being traded. If you're interested in getting started with futures trading, here are some steps to follow. Educate yourself. Learn about the basics of futures contracts, market dynamics, and trading strategies. Choose a broker. Select a reputable broker that offers futures trading and provides the tools and resources you need. Open an account. Complete the necessary paperwork and fund your account. Practice with a demo account. Many brokers offer demo accounts where you can practice trading without risking real money. Start small. Begin with a small position, and gradually increase your exposure as you gain experience. Stay informed. Keep up with market news and trends to make informed trading decisions. To wrap up, futures contracts are powerful financial instruments that can be used for hedging and speculation. If you're new to futures trading, start by educating yourself, practice with a demo account, and never invest more than you can afford to lose. Remember, successful trading requires discipline, patience, and continuous learning. Thanks for watching. If you found this video helpful, give it a thumbs up and share it with your friends. Don't forget to subscribe to Smart Trading Institute for more trading tips and tutorials. See you in the next video. Smart Trading Institute.